Hello, my dear students. How are you all? Let's add value to your knowledge account today. I'm Dr. Bharati Sunil. Welcome to our Finance and Accounting Academy channel. Today's our topic is liquidity ratios. So before going to the topic, I would like to mention what are various financial ratios. Let's see what are those financial ratios. First one is liquidity ratios, profitability ratios, and third one is activity ratios. Fourth one is solvency ratios. So we are going to cover in our future videos liquidity ratios, profitability ratios, activity ratios and solvency ratios. This I will discuss in detail in the coming videos. But in these financial ratios, first we will cover liquidity ratios in today's class. So what are liquidity ratios? Here you can understand why we prepare liquidity ratios. So why we prepare liquidity ratios? We prepare liquidity ratios to know the short-term solvency position of the business. Means if you are doing one business, how we are able to sustain in the short term, means within a period of 1 year, means how we are going to meet your short-term requirements, means your working capital requirements. So for that purpose, what you will prepare? You will prepare liquidity ratios. So we use liquidity ratios to measure the adequacy of current and liquid assets. Okay, to evaluate the ability of the business to pay its short-term liabilities. So first of all, what you will do in liquidity ratios, here we will check what is the adequacy of our current assets so that we can see whether we are having the ability to pay our short-term debts. That is why we prepare liquidity ratios. Before going into liquidity ratios explanation, first I want to show you that I have mentioned you three formulas here: current ratio, quick ratio and absolute or super quick ratio. So how to apply these formulas? To apply these formulas, first of all you should know some terms. Okay, what are those terms? Net working capital. Net working capital means what? Current assets minus current liabilities. So what are current assets? Current assets means cash in hand, cash at bank, means our bank balance. Next, marketable securities means those securities we can easily sell in the market. Those are called what? Marketable securities. Next, debtors. Debtors means sundry debtors. Next, bills receivable. Next, short-term loans and advances. Whatever the short-term loans and advances we have given to others, those also will come under current assets. Next, stock. Stock means whatever the raw material or work in progress or finished goods that are there with us, that are called what? Stock. Next, prepaid expenses. So some expenses will pay in advance. Say for example, if you are paying tax for the next year in the current year, it's called what? Advance tax. Or if you are taking prepaid phone connection, right? So means next term bill you are paying now itself. So these are called what? Prepaid expenses. So current assets covers what? Cash in hand, cash at bank, marketable securities, debtors, bills receivable, short-term loans and advances, stock, prepaid expenses. Okay, is it clear? Next we'll go to current liabilities. What are current liabilities? Sundry creditors. Next, bills payable. Next, outstanding expenses. You know what are outstanding expenses? Say for example, if the March month salary is not paid in March month and it will be paid in the April month, but we are closing our books in the month of March itself. So the salary what is not paid is called what? Outstanding salary. So outstanding expenses will come under current liabilities. Next is short-term loans. If you are taking any short-term loans, and which we have to pay, all what are those called? Those are called short-term loans. Next, provision for taxation. So what the companies will do, companies will make some provision to pay our future taxes. So that is called what? Provision for taxation. Next to proposed dividends. So for dividends, we will make some provisions. Those are called what? Proposed dividends. And next, bank overdraft. What is the meaning of bank overdraft? We'll make some arrangement with the banker to avail some amount more than our amount whatever there is in our bank account. Means it is also like a short term loan. So this bank overdraft also will come under current liabilities. So for preparing current ratios, for preparing quick ratio, for preparing absolute quick ratio, what you should know perfectly, you should know what are current assets and what are current liabilities. If you are given one problem, how you will solve that? From balance sheet, you have to take all the current assets and all the current liabilities and use those current assets and current liabilities to prepare liquidity ratios. Clear? So now, is it clear what is net working capital? From these current assets, if you deduct the current liabilities, then what you will get? Net working capital. See, in examination problem or any problem what you are going to solve from your textbook, that problem did not cover all these current assets and all these current liabilities. If you remember all these current assets and current liabilities, then you can solve any problem in your examination. What's the first formula under liquidity ratios? Is called what? Current ratio. Current ratio means what is the formula? Current assets by current liabilities. I will show you how to solve this ratio. Say for example, if current assets are given in your problem, current assets are 2 lakhs, which may include debtors, bank balance, bills receivable, stock, right? And current liabilities is equal to 1 lakh. Means this current liabilities include bills payable, short term loans, whatever we have borrowed, outstanding expenses, right? So how you will use these amounts to prepare this current ratio? What is the ratio formula? Current assets by current liabilities. Now we will write this formula. Current ratio is equal to current assets by current liabilities. Now what is our current assets value given here? 2 lakhs, right? So 2 lakhs divided by, and what is our current liabilities value given? 1 lakh. So 2 lakhs divided by 1 lakh. So it is how much? 2 is to 1, right? So like that we have to calculate our current ratio. Here you should know that what is the ideal ratio for current ratio? 2 is to 1. Means if current assets are 2 and current liabilities are 1, means we are very much in comfortable position to repay your current liabilities using your current assets. Now coming to the second ratio. Quick ratio is equal to quick or liquid assets divided by quick or liquid liabilities. So what are quick assets? Now I explained you what are current assets. Then what are quick assets? Just remember two items which won't be coming under current assets. From this list of current assets, if you remove these two, what are those two? Stock and prepaid expenses. Means if the current assets total is 2 lakhs and if the stock is 10,000 and prepaid expenses are 5,000, means 10,000 plus 5,000. So it is how much? 15,000. So from 2 lakhs of total current assets, if you deduct this 15,000, what are our quick assets? 1,85,000, right? So like that we have to show current assets minus stock plus prepaid expenses. Here how much of amount I told you? 2 lakhs, right? And we have to deduct how much? Stock is how much? 10,000. Plus what are our prepaid expenses? 5,000. So 2 lakhs minus 10,000 plus 5,000 means 15,000. How much is your quick assets value? 1,85,000. So like this you will get quick assets value. Right? Next, quick liabilities. What are quick liabilities? current liabilities minus bank overdraft. Current liabilities means your sundry creditors, bills payable, outstanding expenses, short-term loans, provision for taxation, proposed dividends plus bank overdraft. So from these current liabilities, if you remove this, means if you deduct this bank overdraft, then it is called what? Quick liability, right? Here I will show you quick liability. Quick liability is equal to current liability minus bank overdraft. Say the current liability total is how much? 1 lakh, right? Minus if the bank overdraft is 10,000. So what is that amount? 90,000. So like this we will calculate quick liability. Suppose in your problem, if bank overdraft is not given, then your current liability is equal to quick liability. So that is why, so this formula we can also show as quick assets by current liabilities. So when you can use these quick assets by current liabilities? When you are not having bank overdraft. Clear? Now coming to the third one, absolute quick ratio or super quick ratio. So what is the formula? Cash plus bank balances plus marketable securities. We will take only these three out of our total current assets. What will take? Cash in hand, cash at bank and marketable securities. We will take only these three because this will be easily, cash means what is there with us in liquid form, right? And bank balance we can easily withdraw from our bank, either by using check or by withdrawing through phone pay, google pay, whatever it is, right? We can transfer immediately, right? Next, marketable securities which we can sell immediately in the market, means which we can convert into cash very immediately. Say for example, if I am having shares in the companies, okay, I can sell easily through grow or some other app and convert that into cash form very quickly. So that is why absolute or super quick ratio means what are the amounts we will consider here? Cash amount, bank balance amount and a marketable securities amount. We'll take these three amounts and we'll divide that with the current liabilities. Whatever the current liabilities amounts are given, we'll use those current liabilities amount and we'll write here, right? And we'll, when we divide cash plus bank balance plus marketable securities by current liabilities, whatever the amount we will get, we should check, because what is our ideal ratio? 0.5 is to 1. Suppose if you are getting 0.5 absolute quick assets and current liabilities are 1, then this is called our ideal or standard ratio. Means, so we can easily convert our current assets by using our cash, bank and marketable securities and repay our half of current liabilities. So this is about current ratio, quick ratio and absolute quick ratio or super quick ratio. Using this information and using these formulas, we do one problem now. Now using this problem, now we'll prepare current ratio, quick ratio, super quick ratio. So what is the current ratio formula? Current assets divided by current liabilities, right? Now what are our current assets? Cash is our current asset. So it is 20,000 less debtors 1,20,000 plus bills receivable 30,000. Next, stock 80,000. Next, marketable securities 25,000. So if you add cash, debtors, bills receivable, stock, and marketable securities, then we will get 20,000 plus 1,20,000 1 lakh 40, 1 lakh 70, 2 lakh 50, 2 lakh 75,000 we will get as current assets, right? Divided by current liabilities. What are current liabilities? Bank overdraft plus creditors. How much? 90,000. Next, outstanding rent. What is the outstanding rent amount? 5,000. So what is the total? 10,000 plus 90,000, 1 lakh, 1 lakh 5,000. So here if you take the total, 2 lakhs 75,000 divided by 1 lakh 5,000. So how much you will get? 2.62 is to 1. But what is our ideal ratio? Ideal ratio is 2 is to 1. So our current assets are more than our current liabilities. Remember, we should not have excess current assets also. So we can maintain ideal ratio of 2 is to 1. So now I will show you quick ratio. Quick ratio is equal to quick assets by quick liabilities, or we can also show it as quick assets by current liabilities. Now what are our quick assets? So what is the amount of our quick assets? Current assets minus stock, because we are not having prepaid expenses. So from our current assets deduct stock and divided by quick liabilities. What are quick liabilities? Current liabilities minus bank overdraft. So how much you will get here? Current assets total is 2 lakh 75,000 minus what is our stock amount? Stock amount is 80,000. Divided by current liabilities total is 1 lakh 5,000 minus what is our bank overdraft amount? 10,000. So is equal to 2 lakh 75,000 minus 80,000. It is 1 lakh 95,000 divided by 95,000. It is 2.05 is to 1. Means here we are having excess quick assets with us. Our quick assets are 2.05 and the quick liabilities are 1. Here our current assets are how much? 2.62 and the current liabilities are 1, right? Now we will see the next one, absolute quick ratio. So here we have prepared first one, current ratio, and here we have prepared second one, quick ratio, and here we'll be preparing third one, absolute quick ratio. So how we'll prepare? Use the formula cash plus marketable securities, because here we are not having bank balance. Take only cash and marketable securities divided by current liabilities. So now see what is our cash amount? 20,000. So 20,000 plus what is our marketable securities amount? 25,000. So 20,000 plus 25,000 divided by what is our current liabilities total? 1 lakh 5,000. So how much you got? 45,000 divided by 1 lakh 5,000. So you got 0.43 is to 1, means our absolute quick assets are 0.43 and current liabilities are 1. So after preparing ratios, whatever you get, that you put that in box. And here current ratio, this is current ratio, and this is quick ratio, and here it is absolute quick ratio. So today we have solved liquidity ratios. So the problem, whatever is given to us, using that problem, we have calculated current ratio, quick ratio, and absolute quick ratio. So here, when the problem is given to you, just you have to understand what will come under current assets, what will come under quick assets, what will come under current liabilities, and what will come under quick liabilities, and what will be taken under absolute quick assets. If you know this perfectly, then you can solve any problem in liquidity ratios. This is about liquidity ratios. That's all for today, but learning never stops. In the next video, we will do other ratios. If you like my videos, please like, share, and subscribe, and share with your friends who are having these subjects. I'm also doing videos in financial accounting, cost accounting, and business economics. So keep learning, keep growing. Thanks for watching. We'll meet in the next video. Thank you.